Imagine waking up, checking your phone, and realizing that, well, a quarter of the global seaborne oil supply has just vanished.
Just completely gone.
Right, gone. Because that isn't, a hypothetical scenario anymore. That is exactly what happened on February 28th when the Strait of Hormuz closed.
Yeah.
Today is May 15th, 2026. It has been 11 agonizing weeks. And a fifth of the world's liquefied natural gas it's still completely choked off.
And, I mean, those 11 weeks have effectively rewired the mechanics of the global economy, like from top to bottom.
Completely. And to make sense of the absolute chaos we're seeing in the markets right now, we've pulled together a real massive stack of sources for you today. We're looking at fresh inventory data from the International Energy Agency.
The IEA, right?
Yeah, the IEA. Plus market projections from Goldman Sachs, policy briefs out of the EU and the US, and some really fascinating industry reporting from places like Aviation Week. But before we get into the weeds of all that, we need to establish the sheer scale of this shock.
Yeah, you really have to look at the historical context to understand what we're living through right now. I mean, the IEA, they aren't mincing words here. They're calling this the largest supply disruption in the history of the global oil market.
Wow.
Which is, saying something. If you think back to the textbook energy crises, like the 1973 OPEC embargo or the 1979 Iranian Revolution.
Right, the ones that everyone always brings up.
Exactly. Each of those historical events removed roughly 5 million barrels of oil a day from the global market.
Which, that was enough to cause absolute panic back then. We're talking gas lines, rationing, people freaking out.
Oh, totally. But this current 2026 shock, we are looking at over 10 million barrels a day removed.
10 million.
Yeah, it is twice the size of the crises that literally built modern global energy policy.
And you feel that like every single time you look at a financial ticker or, frankly, just pay for anything right now.
Oh, for sure.
Brent crude peaked near $126 a barrel in April. It's hovering around $100 right now, which is a 58% spike since the year started.
Yeah, it's staggering.
And reading through these Goldman Sachs notes, the warning lights are flashing red. They project that global oil stocks could drop to the equivalent of just 98 days of global demand by the end of May.
Right, which means we're dealing with a genuine crisis of physical supply here. This isn't just, speculators panicking on a trading floor. We are draining our inventories to an 8-year low.
Exactly. And if you turn on the news today, every single pundit is asking the exact same question. Like, how high will gas prices go?
Right, the immediate panic.
Yeah. But for this deep dive, we're going to look past the pump. We want to explore a much more fascinating long-term question hidden in our sources. We want to know, does an oil shock of this unprecedented size actually force the global energy transition into overdrive, or does it, completely stall it out?
Well, to figure out what a massive shock like this does to our future, we actually have to dissect the past. The only real historical template we have for a disruption this severe is the 1970s.
Okay, let's pull that apart then. Because the 70s defined energy policy for a whole generation.
Yeah.
How did the global economy actually survive that?
So policymakers essentially pulled 3 distinct levers back then. First, they looked for non-OPEC oil, which led to a massive drilling boom in places like the North Sea and Alaska.
Right.
Second, they tried substitution, throwing government funding at nuclear power, early renewable research. But the third lever, and by far the most important one, was efficiency.
Meaning they just, force people to use less?
Well, it wasn't just politely asking people to turn off the lights, right? We're talking about deep structural shifts in how the economy functioned.
Oh, okay.
In the U.S., this birthed the CAFE standards corporate average fuel economy. And this wasn't a suggestion. It was a federal mandate that legally forced Detroit automakers to fundamentally re-engineer their engines to hit a specific miles per gallon average across their fleets.
So it was a law.
Yes. Building codes were aggressively rewritten to require thick insulation. The Strategic Petroleum Reserve was created.
So it wasn't just about weathering a bad year. It was about changing the baseline.
Precisely. The core lesson historians draw from the 70s is that structural efficiency pays dividends for decades. A redesigned fuel-efficient engine, it keeps saving oil long after the crisis ends.
That makes sense.
But that first lever, just finding more oil in Alaska, that didn't fix the underlying vulnerability. It just delayed the pain and set the stage for the next shock.
If I put myself in the shoes of a consumer back in 1973 when prices spiked, I really only had one immediate option, right? Which is what economists call demand destruction.
Right.
I couldn't just go buy a different type of car overnight. I just had to drive less.
Yeah.
Turn down the thermostat and put on a sweater. And the way I think about demand destruction is It's kind of like going on an aggressive crash diet because groceries suddenly got way too expensive.
That's a good way to put it.
Like if eggs are 10 bucks a dozen, I eat oatmeal. I shrink my consumption. But the fundamental problem with a crash diet is that the second prices drop and I can afford food again, I go right back to my old habits.
Exactly.
The demand just bounces right back.
Yeah, that is the perfect way to visualize the limitation of the 1970s response. Demand destruction is temporary. But here's the crucial divergence when we look at 2026. Back in 1973, solar power accounted for less than 0.25% of the world's electricity.
Practically nothing.
Right.
Yeah.
And the electric vehicle industry was basically science fiction. Today, though, the world has mature, commercially viable alternatives. Just look at the baseline right before this crisis hit. In 2025, 1 in 4 new cars sold globally were EVs.
Wow, 1 in 4.
Yeah, we're talking 21 million units.
Yeah.
And solar power led global energy demand growth last year.
Wait, so if I'm a consumer today and I panic because gasoline is suddenly completely unaffordable, I don't just have to drive less, I can actually go buy an EV.
Yes, and that changes the entire economic equation. For the first time in human history, we have demand substitution at scale. You aren't just skipping a trip to the grocery store. You're fundamentally changing the machine that gets you there. Substitution doesn't reverse. If you buy an EV today because of what's happening in the Strait of Hormuz, that car is still an EV 3 years from now, even if Brent crude crashes back down to $60 a barrel.
So the off-ramp finally exists.
Exactly.
But I guess the big question for you listening is, are people actually taking that off-ramp right now, or is this just, a nice economic theory?
Well, the hard data suggests they are sprinting for the off-ramp. Let's look at the first quarter of 2026. Battery electric vehicle sales in major European markets surged by 29.4%.
Almost 30%.
Yeah. And market analysts are directly attributing a massive chunk of that surge to the high petrol prices caused by the Middle East conflict. The shock is translating into permanent fuel switching within a single financial quarter.
Nearly 30% growth in one quarter is wild.
It is, and we see it in the power grid, too. The International Renewable Energy Agency, IRENA, they just dropped a report in mid-May confirming that solar and wind are officially the cheapest sources of new power globally.
Officially the cheapest.
Right. And more importantly, they noted that co-located hybrid systems, where you build a wind farm, a solar array, and a massive battery facility all on the exact same site, are now delivering round-the-clock 247 power at costs that actually beat fossil fuels in high-resource regions.
Okay, wait, I want to stop you right there.
Sure.
Because if I'm listening to this data, a 30% jump in EV sales, renewables officially crown the absolute cheapest power source, batteries solving the intermittency problem, I'm honestly a bit confused.
How so?
Why aren't we just declaring victory? Doesn't it definitively prove that a massive oil shock automatically accelerates the clean energy transition?
I mean, it absolutely feels like we should be declaring victory, right? But this brings us to the core tension we found across all these sources. It's the hidden trap of this entire situation.
The hidden trap.
Yeah. The exact same $100 barrel of oil that creates this massive demand pull for clean energy is, through a totally distant economic mechanism, starving the transition of the supply it needs to actually grow.
Okay, walk me through that. How does an oil shock starve wind and solar?
It all comes down to the mechanics of how clean energy is financed. Think about building a massive offshore wind farm or like a utility-scale solar plant. You have to buy all the steel, the silicon, the turbines, and pay for the labor on day one.
Right.
It requires billions in upfront capital. But once it's built, the fuel, the wind and the sun is free. You are essentially buying 20 years of future energy all up front.
Oh, okay.
And because nearly 100% of the cost is front-loaded, the viability of these projects is incredibly sensitive to interest rates. The cost of borrowing money literally makes or breaks the spreadsheet.
Oh, and an oil shock inherently drives up inflation.
Exactly. This 2026 shock is projected to add roughly 0.8% to global inflation. It raises the specter of stagflation high prices combined with a stalling economy. And how do central banks combat inflation?
They hike interest rates.
They hike them and hold them higher for longer.
Yeah.
Those high interest rates act as a massive invisible tax on capital-intensive clean energy projects.
I see. So to put that in everyday terms for you listening, it's like deciding you want to build a brand new, ultra-efficient, state-of-the-art solar home, but you have to take out a mortgage to do it right at the exact moment that the bank jacks up interest rates to, like 8 or 9%.
Right.
Suddenly, the upfront cost to borrow that money is so astronomical that you just can't afford the build. So even though you desperately want off the gas grid, you're forced to just stay in your drafty old apartment and keep paying the incredibly expensive monthly gas bill.
That is the trap. You are paralyzed by the cost of capital. And there are two very harsh realities that compound this.
What are they?
The first is that global capital is purely mercenary. It doesn't care about the climate targets for 2050, it cares about yield this quarter. With Brent crude sitting at $100 a barrel, drilling a new oil well suddenly becomes the highest return trade on the board.
Because an oil well starts pumping cash almost immediately, whereas a wind farm takes a decade to pay off.
Precisely. The money naturally flows to the barrel, not the battery.
Right.
And the second harsh reality is political, which the IEA points out very bluntly in their analysis. When energy becomes unaffordable, the political space for long-term transition policies just evaporates.
Yeah. People get mad.
Exactly. Voters who are trapped in a severe cost of living crisis, they demand immediate relief. If people are terrified about how they're going to afford to heat their homes this winter, they will punish any politician talking about what the grid is going to look like in 2040.
Wow, so the very shock that should be persuading the public to transition actually burns up all the political goodwill required to do it.
It's a vicious cycle.
Okay, so we have these two colossal forces slamming into each other right now in 2026. On one side, we have a massive demand. Pull consumers are rushing for the EV off-ramp. On the other side, we have a brutal capital laugh-at. Drag interest rates are suffocating new solar projects, and Wall Street is throwing billions back into fossil fuels.
Yeah.
If they're deadlocked like that, what breaks the tie?
Well, if we look back at our 1970s template, the tiebreaker is policy. It all depends on whether governments use the crisis to lock structural changes into law during the shock, while the high prices are providing the political cover to act.
And reading through these briefs, there's a fascinating ideological shift happening that makes passing those laws easier now than it was in the 70s. For decades, energy security and decarbonization were treated as completely opposing goals.
Oh, absolutely.
If you wanted energy security, you drilled for domestic oil. If you wanted decarbonization, you regulated that oil. But today, those two concepts have totally converged. If a country electrifies its transportation sector, it slashes its carbon emissions and completely severs its reliance on imported oil from a volatile choke point like Hormuz.
That convergence is the most powerful argument policymakers have today. The lowest carbon energy system is now, objectively, the system with the lowest exposure to geopolitical blackmail. But recognizing that logic is very different from actually executing on it. And we're currently watching a fascinating real-time global stress test of two completely different economic philosophies trying to solve this exact same problem.
Let's look at that divergence, specifically between the European Union and the United States. And to be really clear for you listening, our goal here isn't to take sides or crown one approach the winner. We are simply, impartially, observing how two massive economies are testing completely different mechanisms to absorb the exact same $100 barrel of oil.
Right. Let's take the European Union first. The EU entered this 2026 shock with heavy institutional machinery already in place, and they are actively trying to channel the high price signal into permanent policy.
Like what?
Take the hydrogen bank, for example. The EU is actively subsidizing the cost gap between dirty fossil hydrogen and green hydrogen to guarantee offtake agreements for producers. They have the refuel EU mandates forcing specific quotas. They're essentially saying, we will use government intervention to force the structural change now, so we are never vulnerable to Hormuz again.
But then you look across the Atlantic to the United States, and it's a totally different playbook. The U.S. actually revoked its federal decarbonization targets post-2025.
Yeah, huge shift.
They are no longer setting top-down mandates for emissions reduction. Now, they still have some mechanisms like the 45Q tax credit, which essentially pays companies a set dollar amount for every ton of carbon they successfully capture and bury underground.
Right.
But by and large, the U.S. is relying almost entirely on raw free market price signals. The philosophy is, if gas is expensive, the market will naturally innovate to provide cheaper alternatives without the government forcing it.
It is the ultimate economic laboratory right now. One system is trying to meticulously engineer the transition through subsidies and mandates. The other is trusting the invisible hand to optimize the cheapest energy path. How those two distinct models perform over the next decade will likely define the future of global energy economics.
Okay, up to this point, we've focused heavily on consumers, road transport, and the electrical grid. We've established that high interest rates trap consumers. But what happens when the consumer isn't, a person deciding between a Honda and a Tesla, but a massive multinational airline?
Oh, that's the exception.
Because aviation completely breaks the rules we've just laid out.
It really does. Road transport can pivot relatively quickly. The EV is physically sitting on a dealer lot waiting to be bought, but aviation doesn't have a ready-made battery alternative. You cannot strap a heavy lithium-ion battery to a 300-passenger jet and expect it to cross the Atlantic.
Which means the aviation sector's only real lifeline is SAF sustainable aviation fuel.
Right.
Now, I've been reading a lot of the recent coverage in outlets like Climate Change News and Aviation Week, and the narrative they are pushing is that this Hormuz crisis is AF's golden moment. The logic makes intuitive sense, right? Since fossil jet fuel is suddenly incredibly expensive, the enormous price gap between traditional jet fuel and SAF shrinks. Doesn't that make SAF an immediate, obvious winner for airlines?
It's a very tempting spreadsheet calculation, but when you look at the physical mechanics of the industry, it's actually a massive cautionary tale. Yes, the price gap is smaller today, but SF cannot simply scale up overnight to catch this demand wave.
Why not? I mean, if the demand is there, why doesn't the supply just follow?
Because of what sustainable aviation fuel actually is. We aren't just, tweaking a refinery a little bit. To hit the zero carbon mandates, you have to build e-SAF synthetic fuel.
Yeah.
You have to build massive facilities that use vast amounts of clean electricity to extract green hydrogen from water and then combine that hydrogen with carbon dioxide sucked directly out of the atmosphere.
Wow.
You are essentially building a colossal, incredibly complex chemical manufacturing industry completely from scratch.
Oh, wow. So the capital requirements for that must just be staggering.
Astronomical.
Yeah.
And that brings us right back to the capital drag we discussed earlier. In 2026, global SAF production is sitting at a mere 2.4 million tons. That is just 0.8% of global jet fuel consumption.
Less than 1%.
Less than 1%. And the growth rate was actually slowing down before this crisis hit.
But wait, don't the EU and the UK have strict laws forcing airlines to buy it anyway?
They have the mandates, yes.
Right.
The EU mandates a ramp up to 32% SAF by 2040, and the UK wants 22% with obligatory synthetic e-SAF mandates kicking in by 2028 and 2030.
Right.
The laws are on the books, but the capital is not in the ground. As of mid-May 2026, not a single European e-SAF facility has reached a final investment decision. Not one.
Wow. Because it requires 10 years of cheap capital, not a 3-month price spike caused by a war.
Exactly. The 2026 oil shock shines a massive spotlight on the urgent need for SAF. It makes the spreadsheet look a bit better today. But a price signal alone cannot instantly fabricate a physical supply chain that requires a decade of sustained multi-billion-dollar investment.
Yeah.
Aviation proves that a shock doesn't magically build factories. It just exposes your vulnerabilities.
So we've unpacked the demand pull of EVs, the brutal capital drag of high interest rates, the divergence in global policy between the US and the EU, and the unique nightmare of aviation. If we synthesize all these sources for you listening, there are really 3 potential futures that could emerge from the reality of May 2026.
Yeah. The analysts broadly categorize them as the base case, the upside case, and the downside case.
Let's hear them.
So the base case is that this shock acts as a partial accelerant. The demand substitution we are seeing, like consumers permanently switching to EVs, that sticks. But the incredibly expensive cost of capital severely slows down the massive renewable energy projects.
So the demand side moves faster, but the supply side drags its feet.
Exactly. Then there's the upside case. This is where global policymakers look at 2026 and treat it exactly like the most successful responses to 1973. They use the political cover of $100 oil to force structural shifts, locking in freight electrification, tightening industrial efficiency standards, and underwriting the capital risk for things like e-SAF.
And if they pull that off?
If they successfully anchor those changes in law while prices are high, 2026 goes down as the definitive inflection point for the global energy transition.
But we also have to face the downside case.
We do. In this scenario, global stagflation takes root. The politics of affordability completely overwhelm any long-term planning. Wall Street and global capital flood entirely back into fossil fuel extraction to chase high short-term returns.
Right, going after the $100 barrel.
Yeah. The policy window slams shut, and when oil prices eventually stabilize and fall back down, the momentum is lost. And we look back at 2026 as a catastrophic missed opportunity.
If you're listening to this right now and wondering how to cut through the daily noise to see which of those 3 futures we're actually heading toward, what is the single metric they should be tracking?
Honestly, ignore the daily fluctuations of Brent crude. The master signal is capital flow. You need to watch where the billions are actually moving.
The money.
Always the money. track clean energy project finance, and compare it directly against upstream oil and gas capital expenditure. The energy sector that wins the capital allocation war over the next 18 months will dictate the infrastructure for the next 18 years.
That's a great point. I want to leave you with one final thought to mull over, something that really builds on the sheer scale of everything we've explored today. Think back to the raw reality we started with: 11 weeks of chaos, 10 million barrels a day choked off, and a global economy holding its breath.
It's intense.
It is. But if the sheer pain of this 2026 shock finally forces the world to permanently substitute imported oil for domestic clean electricity, could this be the very last global oil shock in human history?
Wow.
Imagine a scenario in 2040. A massive geopolitical crisis erupts. A vital shipping lane in the Middle East closes entirely, and the global inflation rate barely even registers a blip.
Because we're decoupled.
Exactly. Because the cars we drive, the way we heat our homes, and the grid that powers our industries simply do not rely on that commodity anymore. The off-ramp from the chaos of May 15, 2026 is physically sitting right in front of us. The only question left is whether we are brave enough and focused enough to actually take it.